All right, guys, welcome to today's session. And we take a look at an important topic, which is very important for the preparer of financial statement. And of course, for the SBR candidates, the candidates writing the strategy business reporting for the case of the ACCA and corporate reporting for ICAN candidates. So the topic is on the natural disasters. When natural disasters occur, what are the area of the accounting that the entity need to consider in its preparation of financial statement? When natural disaster occurs, it destroys the community, and the process of recoveries can take years for that to take place, right? So example of the natural disaster include the volcanic eruptions, earthquakes, droughts, tsunami, floods, hurricane, and pandemics. So for the preparer of financial statement, when such any of these natural disaster occurs, what are the areas of the accounting that the preparer of financial statements need to consider in his preparation of financial statements? One of the areas that the entity need to consider is that of the impairments, right? For the item of PPE, an impairment will occur in such a way that maybe an indicator of impairment occur, like for instance, maybe as a result of the natural disaster, it affect or it decline the demand from the customer. It's an example of an indicator of impairment on the PPE. In that case, the entity need to assess the item of PPE for an impairment. That is, the entity will apply the provision of IAS 36, which is on the impairment of assets, by comparing the carry amount of the assets and its recoverable amount. Where the carry amount of such assets exceed its recoverable amount, that means that there is an impairment on such assets, and that carry amount of the asset need to be written down to its recoverable amounts, and that impairment loss will be recognized in the profit or loss, right? But if the natural disaster leads to the destruction of the item of PPE, there is no need for the entity to start assessing the asset for an impairment. What the entity needs to do is to derecognize the asset in its financial statement, right? Then another area of impairment that the entity needs to consider is that of the IFRS 9 on financial instruments recognition and measurements, right? For instance, for financial institutions like banks might have given out loans to individual and corporate entity. And due to the natural disaster, there is possibility that the number of defaults on the loan payment will increase. And in that case, the entity need to assess whether there is possibility of having a kind of a significant impairments on the financial assets. Now, so the area that the entity need to consider impairment on or to assess for impairment is that of the financial assets measured at fair value through other comprehensive income, and the financial assets measured at amortized cost, right? So there is no need to assess impairment on those financial assets measured at fair value through profit or loss, right? So the other area that the entity need to consider for impairment is that of the inventory. Just for instance, during the COVID-19 that happened is an example of a pandemic, right? There was a kind of lockdown. Some entity could not produce, and demand were also low. So which then means that such manufacturing company will have some items, their stock, their inventory in warehouse that are not being demanded and they are not being supplied to the customer. So in that case, such inventory is already losing in value for staying in the warehouse for a long period of time, right? So the entity need to consider impairment by what? By measure that inventory at the lower of costs and net realizable value, NRV, right? Another area that the entity need to consider is the insurance. One way or the other, due to the natural disaster, items, property of the entity will have been damaged. And before then, the entity would have insured its property with the insurance company, right? As a result of that, the entity will be expecting a claim from insurance company. And there are a lot of uncertainties around the claim that will be received from the insurance company, in the sense that there is an uncertainty around what is the nature of the coverage that the company has with the insurance company, what is the amount that will be received from the insurance company. So there are a lot of uncertainties around that, right? So if it is virtually certain that the entity will receive such claims from the insurance company, then the entity can recognize that in the financial statements as an asset, right? But if it is only probable that the entity will receive the claim from insurance company, then the entity can only disclose what is called the contingent assets, because it is not virtually certain. And when it's not virtually certain, a disclosure should be made on the contingent asset, which is in line with IAS 37 on provisions, contingent assets, and contingent liabilities. Another area that is also very important that the entity need to consider when it comes to the natural disaster is the restructuring provision and environmental damage. For the restructuring provision, when the natural disaster occurs, the entity will like to save costs. So there is a possibility that there will be a whole lot of job losses for some staff, which is a kind of redundancy, right? So a provision needs to be made in that regard. And for a provision to be made on restructuring, it must meet certain criteria as prescribed in line with IAS 37, that the entity must communicate the effect to those that will be affected on that restructuring. And also, the entity must have commenced the implementation of the plan to restructure the organization, right? And for the environmental damage cost, where the entity has the obligation to restore the environment in which it operates to its original position. In that case, and there is a natural disaster, which then means that the decommissioning cost that the entity must have made at the inception, at the commencement of the operation in that environment, might totally be different. That is, as a result of natural disaster, it will have increased the amount of provision that need to be made for taking the environment to its original position. So in that case, there will be additional liability that then need to be provided for, which is in line with IAS 37, right? Another area that is also very important when it comes to the natural disaster is deferred tax. When a natural disaster occurs, it will affect the performance of the entity in such a way that it could result into a loss. And when loss occur from the operation of the entity, loss is one of the criteria that give rise to deferred tax assets. And the entity needs to be cautious, need to consider the criteria for the recognition of deferred tax in line with IAS 12 on income tax, that it must be probable that the entity will have a taxable profits against which to utilize the deferred tax assets. When that is established that there will be taxable profits against which to utilize the deferred tax asset, then the entity can recognize the deferred tax asset in its financial statement. But when it is not probable that the entity will achieve a taxable profits against which to utilize the deferred tax assets, the entity must not recognize the deferred tax assets in its financial statement, right? So another area that is also very important is the going concern of the entity. Due to the natural disaster that occur, one way or the other, the entity maybe has taken some loan with banks. And due to the natural disaster, the entity might breach some of the loan covenants, and it will affect its liquidity to operate for the next foreseeable period. And so the entity need to consider is going concern. And if there is a material uncertainty around the going concern of the entity, such entity must disclose that material uncertainty in its financial statement. But if there is the assumption around the going concern of the entity is not appropriate, it then means that the entity has to prepare its financial statements on an alternative basis. An example of an alternative basis is that of the breakup basis, where the entity prepares financial statements at the lower of fair value and cost to sale. That is the net book value of the entity are used to prepare its financial statement. So that is where the management of the entity have already concluded that it is not feasible that the entity will continue to exist for the next foreseeable period. So those are the areas that the preparer of financial statement have to consider when the natural disaster occur. And of course, when there is a climate change, this area, I mean, the impairment, insurance, restoration provision, deferred tax, and going concern can also be considered in the preparation of the financial statement by the entity. So that is just a brief area on that is what we need, that is the information that we need when it's come to the natural disaster and the climate change. So if you have any comments, you can put it on the chat box and I will certainly respond to that. Thank you very much. See you next time. Bye for now.